Get out now. The housing bubble is about to pop. I'm your host, Steven Van Metre, and thanks for joining me today as mounting evidence shows the housing bubble is about to pop. Let's over to Bloomberg where we picked the story up. The headline is that mortgage businesses seen laying off thousands as volume dries up. I mentioned this in past shows that this would happen. And refinancing applications drop about 45% in 6 months. And the number of people working as brokers for mortgages and other kind of loans, a proxy for total home lending employment, has surged by more than 50% to around 130,000 since late 2019, according to the U.S. Bureau of Labor Statistics. That's right about the highest level since early 2006, just before the financial crisis. But mortgage rates have been rising since August, reaching 3.92% last week, the highest since May 2019. With borrowing more expensive, applications refinance mortgages have fallen about 45% in the last 6 months, according to the Mortgage Bankers Association. And while some employees can be shunted into other parts of the mortgage business, such as making loans for home purchases, layoffs in the industry are inevitable, according to Loan Depot Inc., one of the largest lenders to consumers. But some lenders have already begun to cut back, as mortgage lender Home Point Capital laid off nearly 10% of its workforce. Better.com, an online mortgage lender, fired about 900 workers in December during an infamous video conference call. And lenders in general are trying to find more work for their staff by lowering their standards a bit because, that's worked out well in the past. But nevertheless, they do this. Let's keep going. The credit rating for the average borrower whose loan is bundled into a mortgage bond backed by Fannie Mae or Freddie Mac fell to 733 in January from 750 a year earlier, according to data compiled by Bloomberg. That's still a prime level for the FICO scale that goes from 300 to 850. And the likely decline in mortgage jobs comes after lenders spent much of 2020 and 2021 staffing up. As the Federal Reserve looked for help to ensure the economy didn't implode during the pandemic, it cut interest rates back to zero, and 30-year mortgage rates dropped as low as 2.65% by early 2021 and above 3.5% in early 2020. A flood of loans followed, and with lower financing costs, housing sales jumped, contributing to the overall U.S. economic growth. About 0.45 percentage points of the 5.7% growth in gross domestic product last year was because of the housing sector, and this is what happens in the mortgage industry. Now, I started out my first full-time job working in IT at a mortgage company, and it was back during a relative booming time in the housing market, and they needed some more people to keep their computers running. And what was interesting is because I had access, and my office was on the same floor as all the executives, the CEO, the president, I had direct access to them, and I didn't know anything about the housing market, but I learned a lot. I remember maybe a year later, one day, I came into work, and a lot of people were upset, and a lot of people were losing their jobs. Fortunately, I wasn't one of them, but one thing I learned when I asked the CEO what was going on, he says, look, we have to lay off when things start to drop. When we see applications fall, we have no choice but to cut staff. I said, but what if they pick back up? He goes, well, I'll just hire them all back. I said, well, why don't you keep them around? He says, that's not how this industry works, Steve. He said, if I kept them around, I'm more likely to be closed. I can't afford to do that. It's just the way it works. And so what does that mean when we see all these applications drop? Well, it has a direct impact on potentially the unemployment rate and people for looking for new jobs. But these people won't find those jobs back in the housing market, not with rates rising, putting a risk to the housing market. Let's continue on with the story, because even if purchase volume is strong now, it might fall in the coming months. In addition to mortgage rates having risen in recent months, housing prices have jumped over the last 2 years, making homes less affordable. And I think that is part of the bigger story here is affordability. Let's continue on, because Wall Street Journal headlines that home price growth hit a record in 2021 as the average home prices in major U.S. metropolitan areas rose 18.8%. A shortage of homes for sale led to bidding wars, pushing price growth to new highs. The low inventory has persisted into this year, with the number of homes for sale sliding to a record low in January, according to the National Association of Realtors. First-time buyers are struggling to compete against cash buyers and investors. The share of first-time buyers in the market fell to 27% in January, down from 33% a year earlier. And it's not just cash buyers and investors. First-time home buyers are struggling with prices being too high. And I think that is another sign the bubble is about to burst. Here you see home price growth has started to decelerate in recent months and is expected to slow further in 2022 as mortgage rates continue to increase. The average rate on a 30-year fixed mortgage was 3.92%, according to Freddie Mac, the highest level in some time. But what is perhaps the issue in terms of the bubble popping and with first-time home buyers is we have the U.S. National Home Price Index on a year-over-year basis. And you can see it's running, just shy of 18% year over year. And I overlaid employed full-time median usual weekly nominal earnings. So these are not inflation-adjusted earnings for wage and salary workers of 16 years and older. And that's running, well, almost to zero. And I want you to notice here that going into the dot-com bubble, you see the prices rose, but wages weren't keeping up. And then all of a sudden prices came down, and then prices surged higher due to cheap mortgage rates, thanks to Alan Greenspan, and wages didn't keep up. And eventually there was too big of a gap. Wages were a problem as people couldn't afford it. The bubble burst and prices came down. And then what do we see now? A similar story suggesting that indeed, well, the bubble is about to burst. Let's keep going with the story because Wall Street Journal continues this with mortgage rates close in on 4%. And as I pointed out, meaning people won't need to refi because they have lower mortgage rates already, making home affordability tougher. And I don't think that's just part of it. I think that this home price, wages, and rates are all part of the story, as expectations that the Federal Reserve will raise interest rates several times this year to control inflation are driving up mortgage rates, which are closely tied to 10-year Treasury. The yield on the benchmark note traded near a recent high of 2% on Thursday. And at their meeting last month, as we know, officials at the central bank discussed accelerating the pace of planned rate increases if rate inflation doesn't subside. And when borrowing cost increases, home buyers are faced with a choice: pay more or find less expensive homes. And less costly homes are hard to find in many places, when the median sale price of existing home rose 20% last year. And those of you looking to buy, there aren't a lot of affordable homes out there. And those that do, well, they could sell really fast and still need a lot of work when they're done. And as rates and home prices rise, affordability has become a substantial hurdle for home buyers, according to the head of Freddie Mac. And now we see, as this turns into Bloomberg headlines, that U.S. housing starts dropped 4.1% in the first decline in 4 months. And it starts to make sense of what's really going on here, that the bubble is starting to burst. Now, if you're concerned of what this could mean to your portfolio, if another great financial crisis were to happen, well, you shouldn't be. Be sure to check out Portfolio Shield. There's a link in the corner in the description below. You'll be glad you did. Let's continue on with the story, because high material costs and difficulty attracting skilled labor remain headwinds for builders, inhibiting new construction and aggravating home shortages across the market. So what they're trying to tell you is that the problem in housing is a supply chain issue, when I think the real issue is you have high prices, high rates, and low wages relative to where home prices are going. And that's the recipe for the bubble popping. It's not a supply issue. But nevertheless, it says, moreover, sky-high prices and the recent rise in mortgage rates are hampering affordability. Well, there you go. That's the truth. And at the same time, the increase in building permits and a pickup in the number of homes authorized but not yet started suggests residential construction will remain healthy in coming months. Now, keep in mind, just because a builder goes out and files for permits doesn't mean those permits have to turn into new builds. A permit is just an option to build. It doesn't mean they have to build, and that's a big difference. But now you're starting to see all the signs are starting to come together as refinances drop due to high prices, high interest rates, and weak wage growth, that the mortgage industry is looking to lay off. And that's one of the early signs the bubble is about to pop. And with that, I'm Steve Van Metre. Thanks for watching. Bye now. The content of this video provides education information. It's not intended to provide investment or other advice. This video will not to be construed as a recommendation or solicitation by selling security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steve Van Metre, personal capacity. Opinions expressed in this video that do not reflect the values of Steven Van Metre Financial.